Corporate finance practice problem using OneNote. Expected value in capital budgeting decision uneven payments. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1329 Expected Value in Capital Budgeting Decision Uneven Payments tab. Also note, when using OneNote, look at the Immersive Reader tool. Many of our presentations up top will be mirrored in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, information is going to be up top. We'll go through the calculations in the blue area. We're going to have a similar kind of scenario with this capital budgeting type of decision, but it'll be a little bit different in how we apply our tools for this capital budgeting decision. So we're going to have two capital budgeting kind of decisions that we want to be comparing and contrasting. The typical concept with the capital budgeting decision is we have the initial outflow going out up front, and then we expect inflows to be happening in the future for years into the future. The primary two tools that we would use then being those that take into consideration time value of money, net present value calculations, and the internal rate of return calculations. We have gone through those calculations, net present value and the internal rate of return, in depth in a prior section. So if you want to focus in on them specifically, take a look at that. Now we're going to be adding to it our analysis here for our probabilities and how we can basically work that into our analysis for our future projections. Now, in a prior presentation, we did a capital budgeting kind of process where we assumed that the future cash flows would all be the same. And we didn't know exactly what the future cash flows would be, but we said, hey, we're going to invest in equipment, for example. It's going to have a 5-year life, so the life's going to be the same for each of our estimates. And then we said the cash flows were going to be the same, but we don't know what it is. And therefore, we used our analysis tool here with our probabilities that we've been working on in this section to figure out what the yearly cash flow would be, getting then to the expected value, which we could then use in our net present value calculation. So that would work if we think the number of years would be the same for each of our kind of scenarios within each individual investment, and if the cash flows would be even. But if we have different cash flows that we're expecting in each of our different scenarios, and the length of the payment time is different, we think that possibly, we might get paid for 5 years, and then we might get paid for like 10 years. We don't know how long the future inflows will be beneficial from this primary investment. In that case, we might have to take our 3 scenarios, we imagine our 3 scenarios, and run a separate present value for each of the scenarios. So we won't actually do that here because it'll be kind of tedious and long to do that. So if you want to figure out how to do a present value calculations, again, we've done those in prior sections. But you can imagine a situation where now we cannot just take the expected value for all years and then do the net present value, but rather do the net present value first for our 3 scenarios. We imagine possibly one scenario having year 1 cash flows being different from year 2 cash flows, and maybe having 5 years of cash flow that we expect, and then we could do our present value to get to the net present value using whatever discount rate would be applicable to do so. And then the second one, maybe we expect to get money back, for 4 years or something like that into the future on that scenario, and the cash flows are different from year 1 to year 2 and so on. Then we can do our net present value calculation there, and for scenario 3. So in that situation, we might have to do the net present value calculations first, and then once we have the net present value, we're going to say here of the initial inflows, these are the net present value of the future inflows, then we can compare that to the cost, in our case this time being the 130, to get to the net present value. So in essence, we calculated the net present value for our 3 alternatives here, and then we can assign the probabilities to that net present value calculation. That gives us a lot more flexibility to basically be able to do whatever we want with the 3 scenarios within a particular investment plan. And again, a lot of times with these investments, we don't know how long they're going to be beneficial. We might say it might be benefiting us for 5 years, or maybe it'll benefit us for 10 years. Maybe the equipment will last longer than normal for whatever reason, and we want to run estimates in our options that will take that into consideration. Well, we could do that if we do the net present value first, and then we apply our percentages on the net present value calculation. In this case, we got the inflows, the 190 minus the initial cost, the 130, gives us the 60, the 200 minus the 130, 70, the 90 minus the 130 would give us 40. These would be our net present value possibilities then. Then our probabilities, 20, 60, 20. 60,000 times 20% is 12,000. 70,000 times 60%, 42,000. 42,000 negative times 20%, negative 8,000. Obviously, again, the percent's adding up to 100%. So then on option 2, same kind of thing. We're going to say now we're going to compare it to another option, possibly comparing and contrasting which would be the better of the two. This one we have the initial down payment of the 200,000, same kind of thing. We're going to have our 3 scenarios, but we're going to do the net present value calculation first so that we could run more varied scenarios for each of the 3 and then do our weighted average on the net present value calculation. So these would be our cash flows that we're assuming for the 3, the 400, the 310, and the 50. The cost is the 200 across the board, so the net present value for the first one would be the 400 minus the 200 or 200. Then the second, 310 minus the 200,000 or the 110. Third one, 50,000 minus the 200,000 is the negative 150. Probabilities assigned, 50%, 20%, 30%. Then we're going to say the first one is the 200,000 times the 50%, 100,000. The 110,000 times the 20%, 22,000. And the 150,000 negative times the 30%, 45,000, for an expected value of the 77,000. This, of course, adding up to 100. Now we can compare these expected values, the 46,000 to the 77,000, and do that type of analysis between these two. Now, there are some limitations here, of course, because when we do these net present value calculations, we're usually clearing over the cost of capital. So there could be some situations where if the amount of investment's substantially different, we want to make sure that we're careful on the comparison between these two items. But you can see how this is a method that we could use to apply our statistical kind of analysis tool and still do some more complex scenarios on the 3 scenarios per investment. So that's another way that we can apply this kind of scenario. Also, another way that we'll take a look at in a future presentation to apply this type of probability scenario to a capital budgeting situation would simply be to then have each year of the capital budgeting. So let's say we have one investment project that has 5 years, and we don't know what the actual inflows will be per year. We might want to dive deeper into what we think the inflow will be for year 1 versus year 2 versus year 3. And so we might run scenarios like this for each of the years of the 5 years of the capital investment to better drill down on what we believe the actual inflows will be for each capital investment. So we might take a look at a problem like that in the future.